Now question number 2. In this question, we are required to prepare the liquidator's final statement of account. As we have already learned what is liquidator financial statement of account, it is basically the receipt and payment account. Receipts in the sense from where we are supposed to receive the money, and the payments are the payables of the company at the time of liquidation. So it is basically a receipt and payment account which is prepared by the liquidator of the company. So if we read the question, the position of the Valueless Limited on its liquidation is as under: issued and paid up capital. There is 3,000 11% preference shares of rupees 100 each fully paid up. There is 3,000 share of rupees 100 each fully paid up, and there is again 1,000 equity share, but it is now partly paid up, that is of 50 each, and out of which 30 per share is paid. And now if we see, there is a calls in arrear is rupees 10,000 and call received in advance is 5,000. So 5,000 is payable and basically the 10,000 is receivable. Now preference dividend are in arrear for 1 year. Amount left with the liquidator after discharging all liabilities is 4,13,000. Article of Association of the company provide for payment of preference dividend arrear in priority to return of equity capital. You are required to prepare the liquidator's final statement of account. Now if we see, we have cash 4,13,000. Now there are certain realization which is to be made. That is first calls in arrear, which is rupees 10,000. Now return to the contributors. Now there are certain payments which has to be made, like the first is preference dividend. If we see, there is a 3,000 preference shares of rupees 100 each. So basically 3 lakh worth of preference share is there, on which 11% is the dividend which is payable. So 3 lakh multiplied by 11% will give you 33,000. So preference dividend which is payable is 33,000. Now preference shareholders, we also have to pay the principal amount, the nominal amount of the preference shareholders, which is 3 lakh rupees. And now there is a calls in advance, so we have to pay that calls in advance, which is worth rupees 5,000 given in the question. Received in advance 5,000. These are all the things which is payable. Now we have to pay. So if we see the working note of this question, we can see that we have 4,13,000 is the available cash balance. Out of that, the payment for preference dividend is 33,000. Now the 3 lakh is the preference shareholders capital which we have to pay, and calls in advances of 5,000 which we have to pay. So out of 4,13,000, 3,38,000 is the total amount which we need to pay. So still we have 75,000 in hand, and also there is a calls in arrear of 10,000 which we are supposed to receive. Total 85,000 is the amount which we will have if we recover all this money. Now if in this 85,000, if I add the unpaid amount of the equity shareholder, which is rupees 20 on 1,000 shares, if we see in the question, there is 1,000 equity shares of rupees 50 each, out of which 30 is paid up. So basically 20 is uncalled capital. So now 1,000 equity shares multiplied by 20, so 20,000 is still to be received. So total 1,05,000 is the surplus money which the company has. So now after paying all its liability, if there is any surplus, then it will be paid to the equity shareholders. So this 1,05,000 will be paid to the equity shareholders. But now we have two category of equity shareholder. One is the 3,000 equity share which is fully paid up, and the second one is 1,000 equity shareholder which is partly paid up. That is the 50 is the face value, out of which 30 is paid up and 20 is about to be paid. If I say if I have to bring both the equity shares into one category, then 3,000 equity share of rupees 100 each can be termed as 6,000 share of 50 each. If I say 3,000 shares of 100 each, then I can also term it as 6,000 equity share of rupees 50 each, and 1,000 share of 50 each will remain as 1,000 share of 50 each. So basically we can say that we have 7,000 share of 50 each. So we can say that we have 7,000 share of rupees 50 each. This we are doing to calculate the equivalent number of equity shares, so that we could have one number, so that we can have an equivalent equity shares. So this 1,05,000 which is the surplus money, if I divide 1,05,000 by 7,000 shares, then I'll see that rupees 15 per share to the equity shareholder will be paid when the equity share is of rupees 50 each. So therefore, if I have to say that 15 per share is payable to the equity shareholder of 50 each, then I can say that 30 per share will be paid to the equity shareholder of 100 each. So ideally, the equity shareholders of rupees 100 each will be paid at the rate of rupees 30 per share. So in this account, if we see, equity shareholders of rupees 100 each will be paid at the rate of 30. 3,000 multiplied by 30, so 90,000 will be paid to them. And now out of that 1,000 equity share, 20 rupees is the uncalled capital which we have to call, and 15 is basically the amount which will be paid to the equity shareholders. 20 per share is payable and 15 per share is receivable. So net, if I net off it, then net rupees 5 per share is payable by them. So equity shares of rupees 50 each, 5 multiplied by 1000, that is 5,000 will be paid by those category of shareholders. So this is how the account will be prepared.